Okay, this is a review of monetary policy. So basically, we have the Federal Reserve System, okay, and in particular the Fed, right, which consists of 12 regional Federal Reserve banks, okay. If you look at the country, it's split up into regions. Each division has its own Federal Reserve Bank, so there's 12 divisions of the country. Um, Within each division, like for example, New York has its own division, right? So all the banks in the New York area report to the Federal Reserve Bank of New York, right? The Federal Reserve Bank of New York regulates and checks the books of all the banks in that division. And if any bank needs a loan, they would turn first to the Federal Reserve Bank of New York. Okay, so, and the country is split up among 12 divisions, and each division takes care of the banks in its own area. Okay. Now, all the banks, they're part of one large system. The system is controlled by the Board of Governors. Which is in DC. Okay, and the Board of Governors is 7 members. Okay, 14-year terms, appointed by the President, confirmed by the Senate. Okay, now, aside from the Fed, which is the system of banks, whose primary purpose is to give loans to banks, to regular banks when they need it, and to regulate the banks. In addition to that, the Board of Governors is part of the Federal Open Market Committee, okay, which is the committee that decides monetary policy. Okay, the FOMC it consists of the 7 governors plus 4 presidents of Federal Reserve banks on a rotating basis, 4 out of the 11, and the president of the Federal Reserve Bank of New York is always on it. Okay, so it's 5 presidents of Federal Reserve banks, one of whom is always New York, 4 are rotating among the other 11, plus the 7 governors. Okay? All right, now, when we're talking about monetary policy, how is monetary policy implemented? What are the tools of monetary policy? You have the discount rate. That's the rate that if a bank wanted to borrow money from the Fed would charge the discount rate. You have the required reserve ratio, which basically says what fraction of money on deposit you have to keep in the vault. You cannot lend. That's decided by the Fed. You have open market operations. Okay, which is when the Fed is buying or selling Treasury bills, and by doing that, it impacts the money supply. You have interest on reserves. Okay, all these tools are intended to impact the money supply. And of course, when you set the money supply, that impacts the interest rate. Okay, so that's exactly what monetary policy does. Monetary policy basically decides what the money supply is going to be, which means it decides what the interest rate is going to be. Okay? Now, we also have the federal funds rate, which is another interest rate that is very much related to the regular interest rate. Okay, so let's talk about, um, first let's talk about uh, the direction of each of these things on the money supply. Okay, if you raise the discount rate, you make it expensive for banks to borrow from the Fed. Banks do not borrow from the Fed as much, and then they have less money to lend to the public, which means the money supply falls and the interest rate increases. If you raise the required reserve ratio, you're forcing banks to keep more of their money in the vault, which means they can lend less money to the public, which means the money supply falls, and again, the interest rate rises. With open market operations, if you buy treasury bills, okay, you pay for them, okay. Actually, give me a second. I'm gonna go like this. If you sell treasury bills, okay, so you give the treasury bills to the banks pay with money, so there is less excess reserves in the system. So the level of excess reserves decreases, which means the money supply decreases, because when there's less excess reserves, there's less money that you can lend from. Okay? And lastly, if you increase interest on reserves, you're giving the banks an incentive to keep money sitting on reserve as opposed to lending it out, and the money supply falls, the interest rate rises. Okay, so discount rate goes up, required reserve ratio goes up, interest on reserve goes up. All these things will cause the money supply to go down. Also, if you sell treasury bills. Okay, alternatively, if you drop the discount rate, the other way. Everything goes the other way. Okay, so if you buy treasury bills, excess reserves go up, money supply goes up, interest rate goes down, and goes down, goes up, goes down. Okay, so that's basically the direction of the different tools and their impacts on the money supply. Let's talk about the federal funds rate. Okay, so the federal funds market is the market where banks can lend to each other money in order to fulfill their required reserves responsibilities. So again, if you have a bank that doesn't have enough money in required reserves, they can borrow from another bank. And the money that they borrow is called federal funds. And the interest rate that the banks charge each other for federal funds is called the federal funds rate. Okay, so we have a demand for federal funds and a supply of federal funds, and that's the federal funds rate. Okay, so now let's trace what happens when there's an open market operation. Okay, suppose the Fed buys treasury bills. It pays for them, so the level of excess reserves increases, and since there's more reserve money sitting around, the supply of money available in the banking system to lend to other banks increases, and that causes the federal funds rate to fall. So we also know when the Fed buys treasury bills, the money supply goes up and the interest rate goes down. So you see when the interest rate goes down, also the federal funds rate falls. Alternatively, when the Fed sells treasury bills, they're getting paid, the Fed is getting paid, so that's money leaving the system. So the amount of excess reserves in the banking system falls, which incidentally means there's less money for the banks to lend out, so the money supply will fall and the interest rate will go up. But from the point of view of the federal funds market, if the level of excess reserves falls, that means there's a smaller supply of money that banks can lend to other banks. And that causes the federal funds rate to increase. Okay, so that's the different tools. Okay. So let's actually go over, one other thing. So we have the money multiplier. Okay, is equal to 1 over the required reserve ratio. Okay, and this formula for the money multiplier assumes that that all excess reserves are lent out, and no cash held by the public, meaning people put all their money in the bank. So even when they take out a loan, they deposit it in another bank. And that's what allows the money multiplier to keep growing the money supply. Okay, I'd like to open up some of the let's work on some of the questions from the, okay, let me see. So here we go. Here's one from 2014. Okay, it says the Federal Reserve can influence the supply of money. Assume that the Federal Reserve targets a lower federal funds rate. What open market operation can the Federal Reserve use to achieve the lower target? So if they want lower interest rates, what they would want to do is they would want to buy Treasury bills. If they buy Treasury bills, that increases the amount of excess reserves in the system. It increases the money supply, which will lead to lower interest rates. Also, when there's more excess reserves in the system, the federal funds rate will fall. Okay? Given your answer to part AI, what will happen to the price of bonds? Remember that there is an inverse relationship between the price of bonds and the interest rate, right? So, if the price goes down, interest rate goes up. If the price goes up, interest rate goes down. There's an inverse relationship. So in this particular case, if the interest rate goes down, the price of bonds will go up, which also makes sense because notice if we're thinking about the market for Treasury bills, right, we have a price and a quantity of Treasury bills. So we have a demand for Treasury bills, we have a supply of Treasury bills. We said the way that we're lowering the federal funds rate is by buying bonds. If you're buying bonds, that means that the supply of bonds on the market goes down because the Fed bought them up, okay? And then the price of bonds goes up, okay? Okay. Using a correctly labeled graph of the money market, show the effect of the open market operation on the nominal interest rate. So I'll go back to this after I define the money market. Assume that the Federal Reserve buys government bonds from commercial banks. Based on this transaction, will the level of required reserves in the commercial banks increase, decrease, or remain the same. So if the Fed is buying bonds, they're paying for them. So the amount of excess reserves in the system increases. But the required reserves is a function of how much money is on deposit. That didn't change. So the level of required reserves remains the same. Okay. Another monetary policy action involves changing the discount rate. What's the discount rate? That's the interest rate that the Fed charges to banks when banks want to borrow from the Fed. Okay. Let's look at here, for example, assume that the U.S. economy is operating below full employment. Okay, so if you're below full employment, that means that you have a situation. Here's GDP, here's the price level, here's aggregate demand, here's the short run aggregate supply, and here's the long run aggregate supply with full employment over here. So the amount you're currently producing is less than full employment, the difference being a recessionary gap. So if you want to get out of this recession, you want to push aggregate demand up, okay? And if you're using monetary policy to do so, you would want to lower interest rate, because with lower interest rates, investment goes up and consumption goes up, which means aggregate demand goes up. Okay, so you would want to target lower interest rates. And if you're targeting lower interest rates, the way you would achieve that is by buying treasury bills. Okay, so that means that the Federal Reserve should target a lower federal funds rate. Okay, again, it asks about the money market, so we're going to skip that. Let's see if there's anything else. No, let's go to the next one. Here's another one. So, okay, assume the required reserve ratio is 10%. So in this case, if the required reserve ratio is 10%, that means on $2,000 you're required to keep 200 in the vault. So that means the reserves are all required reserves. There is no excess reserves. What's the dollar value of new loans you can make? So you can only make new loans from excess reserves, but here you have no excess reserves, so you cannot make any new loans. Mr. Smith deposits $100 in the demand deposit account. So that means this becomes $2,100. Calculate the maximum amount of new loans that First Superior Bank can now make. Okay, so in this case, this bank, you have 2,000 in deposits. Okay, you have required reserves and excess reserves. Okay, so required reserves is 200 because you have a 10% required reserve ratio, and excess reserves is 0, so you cannot give any loans. Okay, now this becomes 2,100. So on 2,100, how much should be on required reserves? So 2,100, 10% of that is 210. 210. Okay. We have loans, right, of 1,800. That did not change. Okay. So of the extra $100 that you got in, $10 goes into required reserves, and that means the remaining 90 is now in excess reserves, right? Because basically you started out with 2,000, 200, 0, and 1,800, right? 1,800 plus 200 is 2,000. You have 2,000 and 2,000. When this went up by $100, where did that $100 go? $10 of it went into required, $90 went into excess. So now the question is, how many new loans can this bank give? It can give $90 in new loans. Okay. So calculate the maximum amount of new loans can now make 90. As a result of the $100 deposit, calculate the maximum change over time in loans, right? So if this bank lends out $90, that allows, so in other words, they give a loan of $90, the person takes that loan, deposits it somewhere else. So out of that deposit, right, $9 is going to go on required reserves, $81 is going to be lent out to somebody else. Out of that $81, $8.10 is going to go on required reserves, and 81 minus 8.1, right? 72.9 is going to be lent out. And this can keep going, right, on and on and on, so that in the end, the $90 that started is going to, the total increase in money supply it's going to cause is 90 times the multiplier, which is 1 over 10%, which is 90 times 10, which is $900. So the total amount of new loans that will be created is $900. Okay? What about the total change in demand deposits? So realize the $90 that was lent out, right, was deposited somewhere, and that caused $81 to be deposited somewhere, and 72. So in other words, the total amount of increase in demand deposits was 900, okay, plus the initial $100 that was deposited. So the demand deposits increase by $1,000, right, which is the 900 caused by all the lending that's deposited somewhere, plus the initial 100 that was deposited, okay? As a result of Mr. Smith's $100 cash deposit, what's the maximum change over time in the money supply, okay? So the thing is, you have $900 in new loans that are created. That's an increase in the money supply. Do you count the initial $100 that was put in to the bank? No, because that $100 used to be cash, so it was part of the money supply. It's not like it came from the Fed. So since it's part of the money supply, the $100 doesn't count as part of the new money supply. So only 900 is the total increase in the money supply. Okay? Provide one reason why the actual change in the money supply can be smaller than the maximum change you identified. Well, because A, banks do not lend out all the money that is on excess reserve, and 2, people do hold cash in their pocket. They don't deposit every single dollar. Okay? All right, so that was a very good problem. Okay, so okay. Here's a good one. Okay, so let me, before we do that one, now let's talk about the money market. Okay, so, which is a related issue. Okay, so we said the money market is the market for cash. In other words, how much cash do you want to have in your pocket as opposed to keeping it in the bank? So this is cash, or really we call it money, but we mean cash. And the price of cash is the interest rate, because when you hold cash in your pocket, what you're giving up, the price of that is the interest rate. So the demand for cash is negatively related to the interest rate, because when the interest rate is high, the quantity that people want to hold in cash is very small, because they'd rather keep it in the bank. When the interest rate is low, then people don't mind carrying more cash in their pocket. Okay? And the supply of money is really determined by the Fed. Okay? Now, the demand for cash. Why do people want to have cash in their pocket? To buy stuff. How do we determine what affects that? The price. When prices go up, you need more money in your pocket. Also, when you're buying more stuff, you need more money in your pocket. How do we determine whether you're buying more stuff? That's where the GDP is a good proxy for that. And then payment technology affects also the demand for cash. Okay? So if the Fed increases the supply of money, usually through buying in an open market operation, buying treasury bills, the interest rate would fall. If the Fed shrinks the money supply, usually by selling treasury bills, the interest rate would go up. Okay? What happens if there's a change in price? If the price level goes up, okay, so if the price level goes up, the demand for money increases. At every interest rate, you want to have more money in your pocket at every interest rate. So the whole money demand curve shifts to the right, okay? At the initial level of the interest rate, now this is the demand, the quantity demanded, and this is the quantity supplied. There's excess demand, and whenever there's excess demand, the price has to go up until equilibrium is reached at a higher equilibrium price, interest rate. Okay, so that would be one example. Let's say you have payment technology that allows you to carry less money in your pocket, so the demand for cash in your pocket shifts to the left at every interest rate. At the initial interest rate, now the quantity demanded is less than the quantity supplied, and so therefore there's excess supply, and that drives the price down. Okay, let's do a problem to illustrate this. Okay, let's go back to this. Here we go. So assume that an economy is in long-run equilibrium. Assume that customers wish to hold less money because they use credit cards more frequently to purchase goods and services than cash. Draw a correctly labeled graph of the money market and show how the effect of reduced holdings of money affect the equilibrium nominal interest rate. So in this case, you have the money market. Here's the demand. Here's the supply. So the demand for money is going to shift to the left, and that's going to drive the interest rate down. Based on the change in the interest rate, what will happen to each of the following? So if the interest rate goes down, what happens to the price of previously issued bonds? They go up, right, because they go opposite directions. What happens to the price level and the real income? Well, remember that in this particular, when we go back to our aggregate demand, aggregate supply graph, right, when the interest rate falls, investment goes up, consumption goes up, so the aggregate demand curve shifts to the right, which pushes prices up and income up. Okay, there you go. With a constant money supply, okay, we're going to skip this one. If the central bank wishes to reverse the change in the interest rate, what open market operation would they use? So if the Fed would like to bring the interest rate back up, they would want to sell treasury bills, right? Because if they sell treasury bills, that drives the interest rate up. When they sell treasury bills, the money supply shrinks, and that drives the interest rate back up. Okay, and one last one. I'll just do this one. Okay, so in this case, we said the Federal Reserve wants to lower the interest rate using a correctly labeled graph of the money market, show the effect of the open market operation on the nominal interest rate. So if they're trying to reduce the interest rate, the way we would see it is in the money market. Here's the money, here's the interest rate, here's the supply, here's the demand. So if they would like to lower the interest rate, they would buy treasury bills, which would increase the money supply, which would reduce the interest rate. Okay? So I hope you found this review helpful. Next topic will have to be on the short run and long run determination of the interest rate.